Welcome back to Growing Quality. My name is Elian, and man, Adobe has dropped their earnings, and they were better than expected. Now, these earnings were quite important for me because my portfolio consisted for about 9% of Adobe. That was before the earnings release. Now, Adobe has seen its fair share of issues for competition, for example, but also with analysts. Now, we can see that here, and this was a screenshot I took just before market open today. Now we can see that for the current year, the average EPS guidance, so for 2024, would be $16.78. Now, why do I highlight this? Because this perfectly illustrates the issues that Adobe has gone through. Because in my notes after last earnings report, it was at $18.03. So that's quite a difference. Now, why do I highlight this issue so early on in the video? And that's because it's maybe the overarching element here in this earnings report. We know that Adobe has seen its fair share of competition pop up with AI. For example, OpenAI allows you to make your own videos just with text prompts. And this is seen as a challenge to Adobe's moat. Now, the illustration of the EPS guidance or expectations from analysts shows just that. They went in one quarter from $18.03 to $16.78, and that's quite the difference, of course. And with the expectations coming down as much as they did, well, of course the stock's gonna trade down. That's only logical. But this is purely based on fear. And the question we had going into this report is if those fears were granted, or maybe not. And Adobe just, came in with way better numbers than expected. So this morning or after the earnings release, I tweeted or I posted on X that Adobe is up almost 15% after the earnings, in which it has beat expectation and raised guidance. Now the revenue came in at 5.31 billion versus estimates of 5.29 billion. And EPS came in at $4.48 versus $4.39 of expectations. Now this is non-GAAP EPS, quite important here, but I mean, the differences aren't that great. And Adobe now sees $11.80 to $12 of GAAP EPS for fiscal year 2024 and $18 to $18.20 of non-GAAP EPS. Now, previous guidance was for $17.60 to $18. So they basically said, okay, the best situation we saw is now the worst situation we see. So that's very good, of course. And as mentioned, this was the stock's reaction. Up almost 15%, and it was up way more. Now, this reaction, of course, isn't just from beating numbers. The beats weren't that big, but it's more so with the message that was given with the beat and also what was said during the earnings call. So let's just dive into the numbers first and then we'll go over what was said. Okay, so I highlighted the important parts, and if you see me looking that way, that's because I got my screen there and I can look at it myself as well. So don't think I'm not trying to communicate with you, but that is where I got the screen. And these are a lot of numbers. I'm not going to study them from my head in just a few hours. So what we saw was the revenues on a GAAP basis at 3 or 5 billion and 309 million. Now this was already mentioned, and gross profit came in at 4.7 billion. This is just slightly up from last quarter, so that growth is quite good. Now we saw operating income at 1.885 billion versus 907 million last quarter. However, last quarter was a bit different because we had a big cost or write down from the Figma deal that didn't go through. So then we go to the non-GAAP numbers because all the reconciliations in between. I mean, you can look at it yourself if you want to, but I don't think it's as important. it's good to know, but not to highlight. So gross profit stayed more or less the same, but the net income that ticked up a bit. Now, this mostly came from the acquisition related expenses that were added back in, but we had net income of $2 billion, which is, well, slightly down from last quarter, but more so flat. Okay. So then we had the non-GAAP EPS number of $4.84, and this was the same as last quarter. Now, I do have some other comments about it, but I will get to that at a later point at the end of my video. So if you want to know what I think about these numbers and the guide they gave with it, make sure to stick around. But the non-GAAP operating margin was 46%, and this is right around where they want to have it. So that's good. That more so sounds like business as usual from the numbers perspective. Now, if we look at the income statement real quick, it's important to do so. Also, the balance sheet, I'm gonna run through it very quickly. But we can see total revenues going up by about 10%, a little more. And the cost of revenues ticking up only 4.5%. Now, this is very important because that's the scalability you want. You want revenues to grow faster than your costs in order to increase margins. Now, on the operating expense side, we saw research and development tick up 12.3%. So that's growing slightly faster than revenue. Now, that's not really an issue here because we still have the investment cycle of AI related or related things. And having that R&D expense, well, you can pick it up, you can take it in two ways. Either it's more than revenue growth, or they invest a bit in their competitive advantages, in their moats, and make sure that they do not get overtaken by AI, if you believe they haven't done so already. Now, sales and marketing ticked up for 7.4%, also an important number because it's their biggest expense, but it's lower than revenues, so again, that's good as well. Total operating expenses were up 7.9%, so once again, it's on the good side of the revenue number. Operating income, well, that increased 16.1%, so that's also very good. If we look at the balance sheet, we can see that cash and cash equivalents ticked up slightly, with short-term investment going down slightly. They had trade receivables going down and prepaid expenses ticking up slightly. Property and expenses down a bit, operating lease up a bit, goodwill stayed flat. And on the liability side, well, they now have a bit of debt, about 1.5 billion. So that's on the current liability side. However, on the long-term liabilities, they also have a bit more debt. So they've taken on a bit of debt in the last year, but that doesn't have to be an issue. What they have also done this quarter is a lot of buybacks, but I will get to that in a second. Now, what is a bit, well, not as good to see from this company is that the total stockholders' equity went down slightly, not dramatically, but we generally want to see this ticking up quarter after quarter. So having it take a step back isn't ideal, but it's only minor. Now, I do have some final thoughts about this earnings report, and that is that in general, I'm quite happy with them. As a highlight, we saw the document cloud growing at 19% year over year. This is basically all things PDF related. And that's very good because, well, it's maybe their next level of growth. It's at about $700 million in the latest quarter. So it's getting quite big. Now, on top of that, they also did $2.5 billion worth of buybacks. And that is very good because, well, the stock is down quite a bit. And doing these buybacks now, well, I mean, the stock is relatively cheap. And is it justified? Well, in my opinion, not. And the market seems to agree so far. Now, I'm not going to jump too high too soon because we have seen plenty of stocks trade up in pre-market or after hours trading on all the first initial reactions to an earnings report, only to drop off the day after. So we'll have to see how that goes. But in terms of their guidance, they are seeing, well, $21.4 billion in revenue. That's what is expected of this company. They are already at 10.5 billion with Q4. Well, that's often their strongest quarter. So they are basically halfway through the year, halfway at their guide, with their strongest quarter still to come. So I think they are very well positioned to beat their guidance if things stay as they are now. That's always a big asterisk because we can see the macro economy falling down, or maybe OpenAI is the threat that people think it is. In my opinion, not really, but it may be. For the EPS guidance, they guided for $18 to $18.20. They are currently, so far in the first half of 2024, at $8.96. Once again, almost right at the halfway mark. Also for EPS guidance, or for the EPS, the strongest quarter still to come. So they are positioned very well for this year, and I think that it lines up to be a good year after all. Even if the stock is down, 20% this year, I think it can come back very, very rapidly because I don't think AI is as big of a threat as it's seen. Now, the company is also really not that impacted with enterprise or with AI because the enterprise customers are, well, they are moving up in their tiers in order to get the AI possibilities. So they want Firefly and they're willing to, well, to go a tier up or move up to the next tier in order to get it. So yeah, I think it's a great, great earnings release. I think the numbers, or maybe they are not as impressive of beats, but the message that's sent by it is. They say, the numbers say, or the numbers tell us that the business isn't having all the issues that people expect from it. That AI and OpenAI isn't as much of a threat to their modes as investors think. And well, I'm curious to see how the stock will moving or going through the coming quarter. I have noted the EPS estimates again to see how they will be at the earnings release next quarter. And with that being said, I hope you have enjoyed this video. If you did, make sure to like this video and subscribe to my channel. And with that, thank you for watching. I hope to see you in my next video. Bye.